explaining the format by which we take decisions to take the positions and show the results by part 2 of the webinar. So it is a simple market tracking technique. I will explain it with the details with the following slides. So the derived forecast is used as a guidance because, see, whatever said and done, there are so many factors which influence the markets. And in such a condition, it is not possible for anybody to use a simple statistical analysis and find out what could be the possible moves in the market. And from time to time, you come across various other factors like the fundamental data release and also the hype about the economic conditions of the various countries. And sometimes it might be US dollar centric, or it might be euro centric or GBP centric or Australian dollar centric, etc. As a result, we need to find out what could be the impact in the market. So when an adverse bearish effect is created by one currency, then it might be difficult for other currencies to move against that of US dollar. So this is what we come across. But the players are here to change the market sentiment from time to time. So we need to read their intentions, and that is being done with the help of this algorithmic study. So with which I give the forecast for the week and also for the month, etc. But here in fxtrade.com, I give it on the weekly basis. So this is the slide I showed yesterday with regard to the expected market moves for this week. And yesterday they made a small firm up, and again they just made a swing and firm up move in the case of Euro and GBP now. And slowly they are in positive net change. You can see that. And they are expected to make a swing and rise move during that of the European session. So our webinar is from 8 to 8:45 GMT. So we anticipate a swing and rise based on the forecast. Then we will fine tune the forecast using the market reading technique. Then the market reading technique is being done with the help of the initial lows and the highs noted down around 3:30 GMT. And once we note down the initial lows and the highs around 3:30 GMT, we try to compare it with that of the market. Now it is 8:04 GMT. So actually it is set 5 hours behind. And what are the current levels? 1.118991 are the bid and the ask. And you come across 1.1177 is the low. So the low set around 330 is not been breached. Whereas the high set around 1.1197 has been breached. And they've gone above. During that of the Japanese session, they simply have made a brief upward move above that of the initial high. And now they come below that of the initial low during this session start time. So we will watch how far they were coming down. And for 30 minutes from 8 to 8:30 GMT, if they don't reach the low what they have set, then they will make a rise till end of the session, irrespective of the market condition, or irrespective of the data, what they are going to be released, etc. So that we need to understand. So we need not worry about the type of data which is going to be released or what is going to be the impact of somebody is going to speak and things like that. But ultimately, whatever being considered as an influencing factor, the players can either exaggerate or simply suppress and say that it is already built up in the prices, or they can simply say that that is ignored by the market. So They can give any sort of attribute to that of the data release or to that of the speech or whatever it is, and they can make their own moves depending upon the trap they have done initially. So every session they try to make a trap move, they try to make a small dip in order to give that impression to that of the traders that it could make a drop following the data release or whatever it is. Then subsequently, they just make a brief lower level consolidation and start gaining the levels towards close of the session. So this we need to understand. So what the move we come across during the early part of the session, exactly opposite to that, they do it by end of the session. So if you understand their tricks, then trading becomes a child's play. If they are making a high level consolidation without breaching the high for 30 minutes from start of the session, then they wanted to make a slide. So this, if you follow carefully up to 8:30 GMT and then try to take the position, you will find 100% success rate in your trading decisions. So this is the most vital information which you require, which you are expected to follow. Then we will compare it with the other currencies. GBP 1.5356 is the low, which is not breached. 1.5381 is the high. They have breached the high and went up to 1.5398 and come below that of 5381 and hovering around there. They are making a small swing, but they are not making a breach of the low of their set. Then in the case of yen, 119.59 was the initial low. They just breached it by 2 pips and gone above, and at 120.27 is the high, and that is not been breached. So they intend to make further slide in the case of USD yen, and so any firm up, if you sell, will be able to get profit. Then in the case of CHF, all along they have been gaining the levels, as I was explaining on a daily basis, that they silently gain the levels in the case of euro as well as in the case of CHF as a contrarian move. As a result, you find that euro CHF cross, they made a considerable rise to 1.0708 area, and after some time they will come to 1.10 and quickly gain to that of 1.20, and that was a level wherein SNB was expected, or SNB was suppose have given the comment that we are not supporting the market, and simply the market will go up to that level. So what they have said is different from that of what they have acted. So that is how you find most of the information in the market will be, because in the financial market, if they want to earn money from that of other people, if they tell the truth that this is the truth or this is the economic conditions and this is how the currency values are to be pegged, etc., and people will easily understand, okay, this is the fair value of the currency. There is no speculation associated. Instead, they try to attach a lot of speculations and also a lot of attributes. As a result, you find the currencies undergo fluctuations. And these attributes, we try to follow it using different yardsticks, and they are all not comparable. They are not in terms of pips. So non-farm payroll, which is not measured in terms of pips, how many pips euro has to move or how many pips euro has to drop for the non-farm payroll. It is being referred in terms of thousands of jobs created. And that in turn only triggers the sentiment, nothing more than that. And those sentiments are sometimes a small form of move or a rise or a spike on the upside, or a slide, drop, or a deep downward correction. So this is how they make the moves in the market, and those sentiments are created not depending upon the intensity of the data, but it is more connected to that of the adverse positions of the traders. So if the traders have got enormous adverse positions, you find that they make extreme downward move. That is what happened in the case of USD CHF during the year-end time. They made nearly about 3,000 pips drop and simply said that there is lack of liquidity and many of the brokers were in problem, etc. So that is how they try to trap the institutions. Also, big players are capable of even toppling the governments if they want. And they can make such moves. And now you find CHF is gaining back again as you see that Euro is in positive net change and USD CHF is in positive net change. But ultimately, the players are not interested in conquering the countries. They are interested in making their money. So that is how they try to make the moves in the market, and they are being tolerated and with a purpose. Now, in the case of CHF, 0.9534 is the low, 9598 is the high. They have not breached the high or the low. In the case of Canadian dollar, 1.2515 was the initial low, and they just breached it and came down to 1.2491 and holding below that of 1.2515. So they intend to make a slide. The high is intact. And Australian dollar, 7751 is the low and 78.40 was the high, and they just breached it by 2 pips, and they are holding around that of the psychological level 0.78. So what do you understand that of the market reading? So they intend to make a slow gain in the market. So dips are buy opportunities as the forecast says. So we will try to take the positions accordingly. After doing the market reading, we go in for the trading strategy. That is, we don't take unlimited risk. Instead, we try to limit the risk to 30 pips by using the hedging order. So these are all the session timings for those who are not familiar with the timings of the players. 8 GMT, the European session starts, and we are in this early part of the European session. And 8 to 8:30, if they don't breach the low, and they are sure to gain, and 12:30 to 14 GMT, they will make a quick rise, and you can book profit. Now, we need to understand that what type of moves they are doing at a given time in order to find out what sort of trade we can take a decision. These are all the types of moves they normally do, is namely the stop and the false move, which are happening in less than 30 minutes. And if you watch, they make an upward stop and above that of the initial high during that of the early part of the session, and that means they wanted to make a slide. They make a downward stop and during the early part of the session, and then they want to make an upward rise. So this we need to watch for 30 minutes during start of the session. That is what here, 8 GMT, the European session has started, and now it is about 8:14 GMT. Still, they are not gone below. So which indicates that they were making a small swing here and induce the traders to commit wrongly the positions, and it is considered as a false move. They come up to that of the low and not breach the low and reverse the market, which is referred as a false move. The stop point is a 1. They just come to the low and breach the downward, breach the low and go below for about 15 to 25 pips and reverse the market in less than 30 minutes, come above that of the initial low, and that is referred as a stop hand. Whereas a false move is the one they come closer to that of the low and suddenly reverse in less than 30 minutes and breach the high and stay above and start moving upward, and that is referred as a false move. This false move, they do it before that of the extended or the intentional move. The extended move is a quick move similar to the false move and the stop end, and which happens for 2 hours. And that is again a false move. That is, after making a downward stop end, they go above that of the initial high, stay there, and in every 30 minutes, they just breach the new high. And the last, after 1.5 hours, they stop cutting the new high and reverse the market. This happens as a quick move, as a knee-jerk reaction for many times the data release. And this sort of extended move alternates with that of the intentional move. Intentional move is a slow move, like what you come across now, which is a slow move. It doesn't mean that the market is not having strength. They purposely test the patience of the traders, induce them to commit the positions. And so when the traders look into that of the charts and find that the market is sideways and consolidating, and they immediately go in for scalping. They think that market is not going to head either on the upside or on the downside, then it is better to go in for a scalping, commit a sell or a buy and aim for about 5-10 pips and quickly close the position. And there are some traders, they do even scalping for 2-3 pips, and that will be really now a reckoning process, and they simply become addicted to trading and become jittery and nervous, and because of that they aim for 2-3 pips profit and close the positions, and 2-3 pip loss they close the position. Ultimately they stay where they started, but they will say that they have got enormous experience of trading. That means that the market fear is much more stronger than that of a newbie in the market, and such traders cannot make consistent profit in the market, because once the market fear is there, always anything you look into it, which will be magnified when it is against you. When a candle, you find that it is an upward candle for about 15 minutes, 15 pips, and when you are under the market fear, it will appear like a very big candle on the upside, and then you'll think that following 2 more candles are going to form, and then you try to take a buy after the rise that happened to be the final rise, and then the market reverses. It would have been a move out of a stop point. So we need to understand the type of moves they are doing it, and then accordingly commit positions, rather than looking to the candles. As you know that the time frame you take, the candle get closed after the market. So by the time you read, the market event would have happened, and then you become a late entrant. It is something like entering into or jumping into a running bus, and later on you find it has already reached the destination. So don't do such emotional trades. Calmly watch and identify what sort of moves they are doing it. And swing is the one which they make between the low and the high, without breaching the high or the low, before the data release or before that of the session or during that of the gap time, etc. They make small swings. Then the trading strategy. We use hedging instead of stop if the hedging facility is available, and we take a decision to enter into the market. When the market is near the high and not breach the high for more than 30 minutes, we try to take a buy position. And if it is near the low during the session start, and for 30 minutes, if it is closer to low and not breach the low, we try to take a buy position. Then close the position by end of the session and exit using 30, 45 or 75 pips limit. So what we do is keep 30 pips hedge order to limit the risk. And why 30 pips? Because they make swings for 23 pips. 15 to 23 pips, they make the swings. So during the swing, we should not be hit. At the same time, we cannot keep 50 pips, 60 pips, 70 pips stop or hedge order. And that means that you are afraid of the market. You are not able to read the intentions of the players. That is why you keep a wider stop or wider hedge order. The ideal thing is you should not be hit during the small swings. At the same time, if you keep a tight hedge order, then what happens, even if they hedge you, immediately you'll be able to see the profit in the hedging. And you can watch carefully. After forming a new low, they are not breaching further down, then you can close the hedge with a small profit of 5-10 pips and keep another 30 pips hedge order. And later on, when they gain, we'll be able to move the stop to that of the entry in the buy position and remove the hedge order. So that way you find that hedging helps you to earn money during the either way moves of the market. And besides, in case if we are using the hedging and if the market comes down against you, you can simply close your buy position and maximize the profit on the sell side. And that sort of decisions you can take following the type of moves they are doing it. Whenever it is an intentional move on the downside, if you find that you are hedged and the hedging is making profit for more than 30 minutes, you simply close your buy position and maximize the profit on the sell side. So hedging helps you to capture the profit on either way moves of the market. Ultimately, the market can move either up or down, nothing more than that. And now, if you look into the market, they are slowly doing that at the contrarian move. Now, Euro is in the positive net change, and USD CHF is in the positive net change. As a result, they are just slowly gaining the levels, and they are handling the crosses when the volume is relatively thin. And later on, they will come to the majors anyhow. So now, in 30 minutes of observation, Euro is near that of the low or in the middle level. So we will try to keep a limit order, a buy limit order, because you would have noticed that they came down to 1.1187. So I'm just keeping it as 1.1188, about 4 pips below that of the market, because the swings are very sluggish. So I'm just keeping 4 pips below that of the market, a buy limit order. Instead of buying at the market at 1.1194, I'm just keeping it slightly 2 pips below that of the bid. And also, I'll keep the hedge order. That will be the sell stop. $30 pips below that of the entry. So since it is going to be a buy position, the opposite will be the hedge order. And in the MT4 platform, it is called as a sell stop. Then in the case of GBP, 1.5371 is the current level and 1.5356 is the low. So we will keep it as about 3 pips below by limit. If the momentum is good, we can keep even 5 to 10 pips below the market. But now, since it is very sluggish, so if you keep 10 pips below, they may not fill it. $1.5368. $1.5338 is the hedge order or the sell stop. Then USDN, as I was telling you, that they wanted to make a downward move. So we will try to keep a sell limit order. Why the downward move? Because they did not breach the high, they just breached the low and come above, but they are not following. I mean, as a follow-up move, they are not breached the high again. So that means they just make a brief downward stop and firm up and give that impression to the traders it might go up, but they will continue to slide afterwards. This is the trick of the trade. You need to understand. I'm just keeping current level is 119.75. So I'll just keep it as 78, a sell limit, 3 pips above with the buy stop, 30 pips above. A hedge order. Then in the case of Canadian dollar, as I told you, that the high they are not breached, but the low they have breached it, 1.2491, and they have come above. And I'll try to keep a sell limit order. with a buy stop. $1.2536, 30 pips above. Then in the case of Australian dollar, they just firmed up and came down and cut the high and come down. The low is not breached and they are holding it and will try to keep a small, 3 pips below the current market level, a buy limit. With stealth stop 30 pips below. Okay. So these are all the limit orders I have filled. Okay. None of them are actual market positions. I only kept the limit order. I'll watch for the market to try to fill my orders. If it fills, I'll try to take the positions. If it is not filled by 8:35, that is another 8 minutes, then I will try to modify and take the market positions. Hope you are able to understand. No? We just keep 33 pips below that of the market, the orders, and if it is filled, fine. If it is not filled, then we will try to keep. They're making small swings, but yeah, this is filled. So sell limit has become a sell position. Okay. GBP. Anyway, we'll watch and convert it into positions. So this is how the trading decisions are being taken. So on what are the basis? First of all, the spread between the low and the high should be more than 40 pips. But since it is a webinar, I have to take the position and show you what is going to happen to that of the trades. I just committed positions in most of the currencies, all the majors. But actually speaking, you have to commit positions only in a currency wherein the spread between the high and the low is more than 40 pips. That means that those currencies they are handling. The other currencies, they are keeping it to make sideways moves. That is why we need to understand that. In the case of CHF, they just breached the high and staying above that of the high, they stay up to 9 GMT, 8:30 to 9 GMT, above that of the initial high. That is 0.9598. They stay, then you can take a buy, they will make further rise and you can book profit. So that will be a technical trade, buy above that of the initial high. If they stay for more than 30 minutes, there comes the biggest problem with regard to the other breakout traders. When they breach the daily high and stay above, immediately they try to grab the position, thinking that it will jump up. But we need to wait for 30 minutes. And you know that they either make an upward stop and reverse, or they just breach the high and stay above there for more than 30 minutes to make an extended move for 2 hours only, or they may slowly rise for 2 sessions and start of the third session as an intentional move. And that you have to differentiate. If it is a quick upward move and then they stop cutting the new high, for 30 minutes, that means it is either a stop and or an extended move. But every 30 minutes, if they breach the high formed, that means it is intentional move. So during the intentional move, don't do counter trade. Don't try to sell. They will continue to rise the levels for 2 sessions. So then you will not be able to withstand. And there comes the difference between the slow moves and the fast move, or the quick moves or false moves. The slow moves are the intentional moves. Whenever they are making intentional move, don't counter trade. And you can go in for a breakout trade only during that of the intentional move time, not during extended move or a stop on time. So try to fine tune your other type of entries, breakout trade, using this particular type of moves. Then you will find your trades become successful. Okay. Now GBP is filled. So we'll see how far they will fill the other currencies. I'll explain to you later on by next section what happened to these positions, whether they are filled or not filled. And you can also monitor and note down the levels or take a screenshot and find out what happens to these orders and later on whether they are in profit or not by end of the session. Then you'll be able to understand whether the forecast has come true and also the market reading is dependable. And even if both of them go wrong, the trading strategy helps us to earn money from the market. So that is how you should have the contingency plan while doing the trades. See, simply people will say that you are a low risk profile person or a high risk profile person. And it's just because if they say, somebody says that you are a high risk taking person, it doesn't mean that you are very brave. And there is nothing to do with it of the braveness. It shows that you are emotional if you are taking a high risk. Because if you are trying to take the high risk, and either you should be filthy rich so that if the money is lost, you are not bothered about it, or it does not affect your economy. But if you simply say that I am a high risk individual, just because you are over traded, that shows that you are emotional and you wanted to earn back the lost money as quick as possible. And that is not the right way of entering into the other market. Now, yen is also filled. Okay, euro is also filled. Aussie is also filled. So after keeping the limit order, you wait for about 5-10 minutes. You find those orders are filled. That is called fine tuning of the entry. There is no hurry to enter into the market, and there is no hurry to think that you might miss the market. Keep in mind that they have to swings for 24 hours, all 5 days of the week, they have to make swings in the market. And in that, they cannot continue to accumulate buy position or sell positions. So they take the positions, book profit, take position, book profit, take position, book profit, and do the circular trades. And that's how they do it. So you need to understand how exactly you can fine tune it depending upon the momentum and try to take positions. Now already it is 8:30 GMT. Okay, for 30 minutes they are not breached the low or the highs. Okay, now what conclusion we can make it? They will not make a downward stop point. This is what in a normal condition, they will not make a downward stop point below that of the initial low. If they just not breach the low for 30 minutes from start of the session. So they will not make a downward move below that of the low. So if you keep the hedge order below that of the low, it will be almost 90% safe. 10%, anything can happen in the market because it is the first week of the month. So they are known to make volatile moves, and that could be the chance. So to limit the risk, we are keeping the hedge orders. So these are all the positions now I have taken, and we will see the results of it by 14 GMT. Now I'll try to answer to the questions which are asked here. And if you got any doubt, you can ask me with regard to the trading strategies and how exactly the trading ideas are taken. Then I'm willing to answer to those questions. This session is exclusively meant for explaining the trading strategies and how we take trading decisions. Okay. Cocktail, egg ball, where are you taking profit? Okay, as I explained, the take profit will be near that of the high, that is to close, or 45 pips above that of the buy entry. Because normally, as the days increases, they will try to increase the spread between the high and the low. As I said, that if they make 40 pips spread between the high and the low, and they will go up to that of 75 pips. So in that, you will be able to get at least 45 pips. 45 pips is the ideal exit level. So you need not find out, okay, where exactly the support is, where exactly the resistance is. From that at the entry level, add 40 pips or 45 pips and keep the exit order. I'm not going to keep the exit order now because I'm expecting a rise during the late session. And during the rise, I will keep stop at entry to start with, remove the hedge order. Then subsequently, when the position start making profit for more than 23 pips, I will trail a 15 pips trailing stop in that and keep the trailing stop away during the mid session. During the late session from 12:30 onwards, 12:30 GMT onwards, I'll make it as a 15 pip trailing stop. Then by 14 GMT, 13:30 to 14 GMT, they will make one quick upward rise. My trailing stop will fill the position. And thereby, I'll be able to maximize the profit. So the market might fill my trailing stop or the limit order, which I keep it as 75 pips. Initially, I'll keep 45 pips. The going is good, I'll move it to 75 pips. And the trailing stop will also be working. So the market can either hit my trailing stop or my limit order, and the profit is assured. This is the most important thing a trader needs to learn. However clever he might be, however lucky he might be, however shrewd it might be, but still the market makes certain move in fraction of seconds. At that time, your mind will not be able to take a decision. You will not be able to even see with your eyes. And it is something like a cinematographic move. In cinematography, when the stills move more than 16 frames in a fraction of a second, what happens? We are not able to see them as individual frames. We see it as a movie. So that is our limitation. So understand that when the price moves very quickly, we will not be able to see that. Only if we see, the brain can perceive it and act and give a decision on that. But if you don't understand the limitations, then it will be very difficult for you to understand how exactly the trading has to be done. Because preserving the profit is vital. Just because you have taken the right decision of taking position and subsequently the market is moving in your favor, it doesn't mean that you should be under the grip of greed and continue to talk to everybody in chats and other places. I got a entry here, fine-tuned entry at the lowest level. Market has already gone 150 pips above my buy. So if you simply boost yourself like that, suddenly they may make a drop of 150 pips and wipe you out. So keep that in mind, that there is no question of simply celebrating when the position is making profit or crying when the position is making loss. Instead, control your emotions and try to see that the trading strategy is able to limit the risk and maximize the profit. Then Will has got a question. Say during the mid-session, we have seen 20 pips profit and have placed stop at entry, and the market moves against and hit our stop. Yes, at entry, fine. Then what should we look for to re-enter? So whenever the position is closed at entry, then watch for 30 minutes. And the position when it is closed at entry, and that particular level is breached and the market has come down below and still not breached the low, then after 30 minutes, you can just re-enter into the market. But if they breach the low and come down because of certain other reasons, then you should not take the buy position. Once they breach the low and stay there or try to form the new low, you watch for 30 minutes that new low is not been breached and then try to enter. So entry, it is not the level alone which is important. Even the timing is vital. So if you follow the timings and then try to take the positions, you will not be afraid of the market, let me tell you honestly. Because invariably you do not come across a method which shows how exactly we have to follow the timings of the market. Everybody says that you follow the chart, you follow the other statistical methods, etc. But simply ignoring the time. When you ask any analyst what is the time you have to follow, they will say that you follow 30 minutes chart or 4 hours chart or 5 minutes chart and things like that. Actual entry time, the exit time is vital. Because if you read the intentions of the players, then the players cannot cheat you again and again. If you think that the market is not manipulated and it is God made and the market cannot be controlled by anybody, then it is extremely difficult for you to earn money from the market. Because it is a man-made market. Only if the men make the moves in the market can make the moves. And if nobody is keeping a higher level buy or a lower level sell, the market will not make any sort of moves. So the players have to necessarily make the moves in an online trading platform. You can't keep even 1 pip above that of the market level, a buy order. You can only keep a sell stop or a buy stop above the market and below the market. But at the market, you will not be able to even keep 1 pip above that of the market level. But how the market is jumping upward, only in the banks they will be able to place such orders. And such orders, they do it with a specific purpose. So that is how they manipulate the market. So if you understand, then you need to read their intentions, what they intend to do. And for that, they have the timings. That is why if you follow their own timings followed, then you will find that reading their intentions is much easier. So you have to watch for them to make moves for another 30 minutes. Suppose by 11 GMT it is filled, then wait up to 11:30 GMT and see that they come only close to low and not breach the low or make a small dip or hovering around the same place and try to take a buy. In case by 11 GMT your stop at entry is filled but the market is staying above for more than 30 minutes, then you buy even at a higher level. They will make a rise. You can understand that it was filled during a small dip. That is how the re-entry has to be considered. Why is it recommended to read market at 8:30 GMT? That is what? No, 8 GMT is the start of the European session according to the players. And for 30 minutes, if they don't breach the low, now we have noted down the lows, right? And they are not breached the initial lows. They are all noted down by 3:30 GMT, and even by 8 to 8:30 GMT, they are not breached the lows. We will come back by 14 GMT and see what happens to those lows. I was telling you, if they don't breach, they will not breach it till 14 GMT. Let us see whether it is happening or not. So for 30 minutes, 8 to 8:30 GMT, if they don't breach the low, they will not breach the low till end of the session. That is why we wait till 8:30 GMT. Then squib. How to anticipate whether there is a swing, slide, rise, etc. in the coming session. Okay, see, in order to derive the rise, fall, or the swing, slide, etc., I spent nearly 14 years to develop the algorithm. It is not such an easy way we can find out whether they are going to rise it or drop it or whatever it is. No, and it is a Herculean task. And it is not ordinary statistical calculations, it is a sequential calculations. And so, see, now today we are on Tuesday. I'm talking about that they are going to rise during that of the ECB and ECB press conference on 5th of March. I'm giving the forecast that for non-farm payroll, they'll make an upward quick spike. We just watch on those days and understand. So it requires so much of analysis and the understanding of the market. It has to be done in a very scientific way. You cannot speculate simply. Then today, do keep in mind the important economic data. As far as the data is concerned, I don't keep in mind the economic data as a whole, but I only keep in mind the time at which they are going to be released. Okay, 13:30 GMT with non-farm payroll. Then what is going to happen in the market by 13:30 GMT? I just note down. I'm not worried really whether the non-farm payroll will be positive or negative. For the simple reason that many of the occasions you would have noticed that non-farm payroll would have been very negative, and everybody will be expecting euro and GBP to go up, US dollar to weaken, and they will simply gain the levels euro and GBP briefly, and then subsequently slide them again. Subsequently, they drop euro and GBP with a simple excuse that market is having risk aversion. Even though the non-farm payroll is negative, simply they will say the people are risk averse. So what you will do? Whether you give importance to that non-farm payroll or risk aversion. And there are occasions wherein non-farm payroll was really positive and everybody expect euro and GBP to drop, and simply they will make an upward spike in the case of euro and GBP and say that market has got a risk appetite. Market means what? The big players have got the risk appetite. So whatever the move they do, we have to follow, or we have to say that that is a move in the market. And if they say only 4-5 players are bullish in euro and GBP, the entire analysts have to become bullish, and the entire market people have to become bullish. And when you become bullish and confirm, okay, I'll take a buy, I'll take a buy, I'll take a buy, by the time the last person takes a buy, the market reverses. That's all. And the players will say that, no, technically it was overbought conditions, so the market reversed. So every time you find this sort of uncertainties continue to prevail in the market. And that is why people suffer loss. So you have to always, so it is something like you're entering into a game in which you know the opponent's weakness and strength. As an individual game or a group game, whatever it is, if the two teams are playing against each other, they need to find the strength and weakness of the individual players, and accordingly they have to handle it. But unfortunately in the market, you know that your strength and weakness, your weakness is the limitation of the equity, but you do not know the strength and weakness of the players. And that is the biggest challenge. But how to find out? You should be smart enough to find out. How? Because in the market, whatever be the strength and weakness of the players, they make the false move to start with. When they make the false move to start with, expecting the traders to commit wrongly, and then later on make a reversal of it. Okay, all false moves are quick moves. They quickly make a dip in the market, understand that they wanted to rise. They quickly rise in the market, understand that they wanted to make a drop after the stop point. So read their intentions accordingly and then try to commit positions by following the type of moves they are doing it in the market. Then you will find that against whom you are playing, then you will not overtrade, knowing the size of the opponent. So if you know that the players are really giant and they will not be able to bother about whatever the quantum of positions you take, because they have got a bigger absorbing capacity of the positions. Their equity is not limited like ours. So invariably, there is no point in over trading in the market, or there is no point in fighting against the market. And we have to only earn out of our smartness. And that is the only way to make money. And if you want to exploit the smartness, we need to read the intentions of the players, find their weaknesses. After making a small downward move as a false move for 30 minutes during session start time, then they will gain opposite if they don't breach the low. And at that time, you try to take a buy. See, I can take a buy 5 or 10 pips above, that doesn't matter. But ultimately, what is more important is they should make a rise so that I'll be able to book profit. And to limit the risk, I have to the hedging order, because as long as we are human, we are bound to commit mistakes in our reading. And at that time, our equity should not suffer. That is why I'm recommending the hedge order to be placed always. Anyhow, there is no ambiguity as far as the weekly forecast is concerned. I am displaying it in FX Street, exclusively in FX Street on Monday Asian Session Live Market Analysis webinar, the expected market moves for the entire week. So that is going to be available for the small traders, and you can carefully note it down, and it is free, and we are not expecting any money out of that. And we want you to make money by making use of it. First test it, find out whether it is working for you, and then subsequently you commit positions. And also take the risk aversion positions like the hedging orders, and then you find that slowly you are able to build up your equity. Then you will gain your confidence. Rather than giving more importance to that of the forecast, give importance to that of the trading strategy. You'll be able to successfully earn money from that of the market. Then do keep in mind the I explained it. How far could you expect S&P 500 to rise? See, you will come across the rise in the case of the stock markets till the month of May. So you cannot stop it. Then can GBP test 1.55? Yeah, by end of the week, we should be able to see that it is going above. Okay. I have given in the Asian Session Live Market Analysis the expected range in which the currencies are expected to swing. The high GBP could go is 1.57 area. Okay. Okay, no more questions. So you can take a screenshot, otherwise I just note it down. I'll come back by 14 GMT and show you what happened to those positions. And also we will read the market again, where exactly the market is by 14 GMT. And also I told you as an important event to be observed that they will not breach the lows. See whether they are not breaching the lows by 14 GMT. Then you'll understand, okay, they have a very specific type of moves in the market. Then you will be able to understand how, even though the players are big moneyed people, they are also human. They do have their limitations. As long as we are human, we are bound to have our own limitations. We might be having billions and billions of dollars, but we can only eat bread. We can't eat dollar. So these are all the limitations. Understand that they are trying to make their own profit, but we should also, there is no point in yelling at them. Instead, try to see how along with them we can also make money and be happy and increase our lifestyle comfort, etc. So kindly track the market between 8:45 to 14 GMT, and I'll come back by 14 GMT and take the second part of the webinar, and then we will see what happened to the positions, what I committed, and also to the market levels. And some of the challenges I told you that low will not be breached. Let us see whether it is happening or not. Thank you one and all. See you by 14 GMT.